Imagine maxing out every line of credit you have, then turning around and lending yourself the money to pay it all off. That sounds like financial insanity, a loop that would bankrupt any individual in months. Yet this is exactly how the United States government funds itself. It borrows money by issuing bonds, then buys those bonds through its own central bank. On paper, it seems the U.S. is paying itself with money it doesn't actually have. In reality, this is the boldest financial trick on the planet, the hidden engine of the global economy. The question isn't whether it works, it's how long the illusion lasts. To grasp the bond trick, we must start at the foundation. A government bond is, essentially, an IOU, a promise from the Treasury to borrow money now and repay it later with interest. At first glance, bonds are meant to be the safest investment in the world, backed by the full faith and credit of the United States. For more than 2 centuries, that faith has allowed the U.S. to spend far more than it collects in taxes, running deficits without fear, confident that someone will always buy its debt. This confidence did not appear overnight. After the Revolutionary War, the fledgling United States faced mountains of unpaid bills to soldiers, suppliers, and foreign allies. Like France, Alexander Hamilton, the nation's first Treasury Secretary, recognized that issuing new bonds to honor old debts could build trust. By showing creditors that America would pay its obligations, Hamilton established credibility, convincing investors to keep lending. But this created a permanent cycle. Borrow, repay with new debt, issued fresh bonds. Debt became the lifeblood of American finance, a structure that persists today. The real game changer came with the Federal Reserve's creation in 1913. Prior to the Fed, the U.S. banking system was fragile, prone to panics and collapses. The central bank was designed as a stabilizer, a lender of last resort, but it quickly became a partner in sustaining government debt. When World War II demanded unprecedented funding, the Treasury turned to the Fed to ensure the government could borrow at low cost. The Fed agreed to buy government bonds when needed, effectively guaranteeing demand. Suddenly, America had discovered a way to finance itself reliably. The central bank could simply create money and purchase the debt directly. Then came 1971, a pivotal year that transformed this strategy into a global phenomenon. Until then, the U.S. dollar was tied to gold. Other nations could theoretically exchange their dollars for gold, anchoring trust in something tangible. But ballooning debt from Vietnam War spending and domestic programs tested that trust. President Nixon ended the gold standard, severing the link between currency and a physical asset. From that point, the dollar's value rested solely on faith, the willingness of investors to keep buying treasuries. Paper replaced gold, and trust became the cornerstone of the system. Today, the cycle continues. The Treasury issues bonds to cover deficits. Buyers include foreign governments, pension funds, banks, and insurance companies. They purchase treasuries because they are viewed as the world's safest asset. Yet the most powerful participant is not a foreign bank or investment fund. It is the Federal Reserve itself. The Fed doesn't raise taxes or dip into public savings. It creates money digitally, typing numbers into existence. When the Fed buys bonds, it credits the seller's accounts, injecting fresh money into the system. The government has borrowed, the Fed has bought, and the cycle endures. To observers, it appears as though the United States finances itself with invisible money, and in a sense, it does. This mechanism is not theoretical. It has been employed aggressively in every major crisis of the last century. After the 2008 financial collapse, the Fed implemented quantitative easing, purchasing trillions in treasuries and mortgage-backed securities to stabilize markets. During the COVID-19 pandemic, it expanded this approach, buying unprecedented amounts of government debt to fund emergency spending and stimulus programs. Without this bond trick, the government would have faced stark choices: raise taxes dramatically or slash expenditures. Politically, neither was feasible. Instead, the Treasury leaned on the Fed to fill the gap, and the illusion of seamless financing continued. The winners of this system are clear. Politicians gain the ability to spend without confronting taxpayers directly. Banks and investors receive liquidity, and asset prices benefit from the Fed's purchases. Foreign governments still hold treasuries as a secure investment for now. The losers are ordinary citizens. Every dollar created to buy government debt dilutes the value of existing money. Prices rise, savings erode, and wages fall behind inflation. This hidden cost inflation is a quiet tax that funds the government's spending without appearing in official budgets. Over decades, the United States has accumulated over $30 trillion in debt. Foreign appetite for treasuries is decreasing, with countries like China and Japan reducing their holdings. As global confidence shifts, the U.S. depends increasingly on its own central bank to maintain stability. More money creation means more inflation, pressure, and greater fragility if faith in the system falters. Empires throughout history have used debt as a tool of power. Britain financed its navy and colonies with bonds until post-World War II strains overwhelmed the pound. France relied on similar tactics in the 1700s, only to collapse into revolution when trust eroded. The lesson is unmistakable. Debt can fuel power, but only as long as faith endures. The United States remains unique due to the dollar's status as the global reserve currency. Oil, commodities, and international trade are priced in dollars. Central banks around the world hold treasuries as their safest assets. This creates a loop. The U.S. issues debt, global actors purchase it, and the dollar maintains dominance. Trust in American IOUs forms the backbone of a financial empire built not on gold or territory, but on confidence. Yet cracks are emerging. Nations in the BRICS bloc explore alternatives, stockpiling gold, and discussing ways to reduce reliance on the dollar. If foreign buyers lose faith in treasuries, the bond trick could unravel swiftly. Why does this matter to you? Because the bond trick isn't abstract. It shapes your daily life. Every treasury purchase by the Fed injects new money, diluting the value of your dollars. Grocery bills rise, mortgages become more expensive, and wages struggle to keep pace with inflation. The hidden tax of money creation transfers wealth from everyday people to asset holders. Stocks, real estate, and other investments benefit, while cash and savings lose purchasing power. The system works as long as faith in treasuries and the dollar persists. Once that trust falters, consequences ripple through the economy. History offers warnings. In 1920s, Weimar Germany, government money printing to cover debts triggered hyperinflation, wiping out savings almost overnight. In the 1970s, after Nixon ended the gold standard, the dollar's value collapsed, and Americans faced double-digit inflation at gas stations and grocery stores. More recently, quantitative easing and pandemic stimulus echoed these patterns, manifesting in rising prices, housing market bubbles, and market fragility. Inflation is only part of the danger. Financial fragility is the greater threat. A sudden loss of confidence in treasuries could force the U.S. to finance debt entirely domestically, escalating money creation and imposing an even steeper inflation tax on citizens. Understanding the bond trick exposes how power and money intertwine. The government sidesteps hard fiscal choices by borrowing from itself, shifting the cost onto the public. Debt rises regardless of political leadership because the bond trick is structural, not partisan. It is an invisible machine keeping the empire running. Until it does not, every crisis, from wars to economic crashes, demonstrates the same principle. Debt sustains power, but only while trust holds. When faith erodes, the system risks collapse, and ordinary citizens pay the price. Your financial awareness becomes crucial in this environment. If the system falters, are your assets protected? Will your savings maintain value against rising inflation? Do you understand the vulnerabilities in pensions, mortgages, and wages? These questions matter because when the bond trick stumbles, it won't be Washington or Wall Street paying the cost, it will be you. Observing history, the pattern repeats. Empires that borrow too heavily eventually face reckoning. America's strategy is no exception. Borrowing endlessly, relying on its own central bank, and projecting stability creates a fragile illusion. Yet, the system persists due to the unique role of the dollar. International trade, global reserves, and the Fed's ability to create money allow the U.S. to maintain this delicate balance. Even so, whispers of de-dollarization, alternative currencies, and gold stockpiling signal potential challenges ahead. The bond trick is no longer guaranteed to succeed indefinitely. While it has fueled decades of American growth, stabilized markets during crises, and allowed wars and social programs to proceed without immediate taxation, It carries hidden costs, inflation, dependency, and vulnerability. Recognizing this framework allows you to see beyond surface economics. It explains how fiscal power operates unseen, how government choices affect ordinary citizens, and why debt continues to grow. The bond trick is both a lifeline and a warning. It underlines that trust, faith, and perception are as crucial as gold or revenue streams in modern finance. Understanding this process equips you to anticipate risk, protect assets, and interpret the economic signals shaping your daily life. Awareness of the bond trick is not theoretical. It is practical, urgent, and essential. So, what's the takeaway? That true financial awareness comes from seeing through the illusion. Understanding that government debt isn't cost-free, that inflation acts as a hidden tax, and that trust is the fragile bridge between stability and collapse. It means asking tough questions about your own money. If the system falters, do your assets retain their value? If prices soar, will your savings keep up? If confidence in Treasury slips, do you grasp the risks in your pension, your mortgage, your paycheck? Because when the bond trick breaks down, it won't be politicians or Wall Street paying the price. It will be you. History rarely repeats, but it rhymes. Britain once funded its empire with bonds until faith collapsed. France sank under debt before revolution swept it away. And now America plays the same game, borrowing endlessly, purchasing its own debt, and selling the illusion of permanence. Illusions end. The only question is timing. If this changed how you see the system, hit subscribe. History holds the answers, and I'll show you where to find them.